Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Okay, so I'm running through things that are at all-time highs. Stock market, U.S. stock market, Bitcoin, gold. Everything just keeps going up. What are people supposed to do when things only go up, Eric?
Well, first of all, just appreciate it. There's so much angst out there.
Okay, I'm over that.
These columnists and the economists, and everyone's like trying to be like, well, it's just something's wrong. And I'm like, everything's going pretty good. Enjoy it while it lasts. But this is probably as good as it gets. It can't last forever. It never does. So the question is, what will derail this? The higher the markets go, the less it takes, right? Because there's a lot of people with itchy trigger fingers like, well, if this little thing happens, they're more likely to take some profits quickly than rather wait. So we'll see what that is. But I think the more things go to all-time highs and the more everything is at all-time highs, that's what's interesting. Gold and stocks rarely are going up together. I think that really makes people nervous. But at the same time, I am pretty happy. My 401k is loving this.
So really, though, how are people supposed to navigate this?
That's the thing. Like, as the markets go up more and more, people are starting to think, okay, what can I use as a little bit of insurance just in case things go south quickly? And there are various vehicles in the ETF market that are really good for this. The problem is a lot of them come with, it's like you got to read the owner's manual on these. So there's a lot of options, but some are really powerful, but they need explaining. And I think it's a good time to go through these things because you just sense something that's going to happen soon. And instead of talking about these things after it happens, we should talk about them right now.
All right. Well, to help us navigate our angst, we're going to be joined by Bernard Goyder, who's an options reporter with Bloomberg News, as well as Suzanne Woolley, who's a personal finance reporter with Bloomberg News. This time on Trillions, protecting your portfolio with ETFs. Bernard, Suzanne, welcome to Trillions.
Thank you.
Good to be here.
Bernard, I want to start with you because you just published a story recently. Investors pile into funds betting on elusive market volatility. Volatility there was a little bit of that in April, I think, when Trump unveiled some tariffs or talk of tariffs. Since then, kind of disappeared. So what are we starting to see show up in markets now?
Yeah, well, people are basically trying to allocate to what happens if volatility comes back. If there's another April situation where there's suddenly a big spike in volatility. And I kind of think of volatility in quite a binary way in markets. Like it's either kind of everything's very, very quiet or everything's extreme. And part of this is going back to this idea about how easy is it to trade. And in periods when everything's fine, kind of like it is now, and the VIX, which is one of the indicators of volatility, is below about 20, it's really easy to trade. There's a lot of liquidity everywhere. And then when stuff gets choppy, sometimes that liquidity pulls back. It's harder to trade. It's more expensive to hedge. And yeah, the VIX goes up. And in those situations, that's when it kind of gets exciting, right? In terms of being a volatility reporter. So at the moment, things are kind of quiet and it's a little dull. But back in April, like things get really exciting.
Listen, Joel, you also get a lot more clicks.
Yeah.
It's like the Weather Channel. You only tune in when there's a hurricane. It's like that for us too.
Okay, so what's going on beneath the surface, and where are investors? And these aren't retail investors so much as professional ones. Where are they starting to allocate?
I'd say that some of these probably are. There's probably some retail guys involved in this because the real professionals will be directly using futures and options and all that kind of stuff. So those investors are generally kind of they spent post-April kind of worried about this return of fear. And I think now we're in the greed stage. So people are allocating to like upside. That's become the big thing. That's why volatility isn't really here, because everyone's just like getting greedy and being like, okay, but what happens if the S&P goes to 7,000, 8,000? What happens next kind of thing? And this is why people have been talking about this hated rally, because they hadn't really allocated to it, but the rally happened anyway. And a lot of people missed out. So they're like, okay, let's go all in. So that's why you see stuff like levered ETFs, where you're kind of doubling up, that those kind of things become popular. And there's also September was the biggest ever month for options in history, basically. Like that was a relatively quiet month from a volatility point of view. But the number of options, it was over 60 million options contracts traded in the US market. It's been a really kind of busy time for options, but people aren't necessarily they're hedging, but they're also betting things are going to keep getting better. So there's a bit of a balance between those two forces.
And I want to go over the VIX ETFs and their flows, which I think is what caught your attention. In the past month, basically all of them have taken in a good amount of money. They've grown their assets by about 20% in the past month. And year to date, they've grown their assets by 50%. Now, a lot of these ETFs are a lot like buying insurance. You're kind of expecting the money to just go away unless the hurricane comes. And so the total assets in these is always deteriorating. It's like a melting ice cube. But anyway, $2 billion in year-to-date flows for these VIX ETPs, especially after all that's happened. And, they went through a lot of bad press over the years. The reason they're complicated as a hedge is that they don't track the VIX directly. Nothing can. It tracks futures. And you have to roll those. And the cost to roll can be really high, like up to 40, 50% a year, sometimes more. And so people buy these, I think, as a hedge, and then they get out of them if it didn't come. But to me, it's, I guess, very akin to buying insurance that will pay off big time.
And when you think about how to rate stuff like this for the movies, right?
Our traffic light system?
Yeah, traffic light system.
Yeah, these are all red lights, hardcore. Anything that rolls futures is a red light automatically.
Is there a double red light?
There is. Well, we were going to have a skull and crossbones,
Yeah.
which would be the equivalent of like an NC-17 movie, ETF style. There was a 2x VIX would be one of the very few ETFs that would be double crossbones. And the reason for that is now it's leveraged and it rolls futures. So all of these VIX ETPs, if you look at their like lifetime return, they're all down 99%.
Juggling a chainsaw on a Swiss ball.
Yeah, I mean look, just rolling futures, whether it's oil or VIX, is just something not many people are aware of. And in VIX, the roll costs are so high that you just hate someone to go in thinking that, oh, I'm buying the VIX. You're not. You're buying VIX futures ETFs that roll them. And then on top of that, there was one that was an ETN, which automatically gets 2 points too.
Exchange traded note.
Leverage. TVIX was the ultimate high score in our system. It got 17 dings. That's the most you can get. Basically, anything over 5 is rated R. So if it got 17, I mean, it's literally like, remember Faces of Death? That movie like from the 80s that like, you couldn't get in the video store?
No, because I never found it.
It's like that. TVIX was that movie. And TVIX was rolled futures, leverage, and an ETN. That said, it blew up. It went away. A lot of these have come and gone now, but they're reincarnating some of these ETFs. So now we do have another 2x VIX, and the whole family is there. But again, it's a very small market. This is for a niche audience, but they still are very active.
Well, what's interesting, so to quantify that kind of skull and crossbones, UVIX year-to-date performance down 70%, minus 70. So
that's where the volatility is. It's non-existent.
Yeah, but if it could go up 100 or 200% in a week. So it's pure. This is kind of pure gambling stuff.
Yeah, let me jump in real quick here to just finish this off because people need to know this. Why would you buy something that rolls futures and loses 70, 80% a year and doesn't do anything? Well, here's why. When the market drops and there's a bad day, so let's look at April 2nd to the 4th. That's when the tariff tantrum was in the most palpable. Market's down 10% in 2 days. The negative 3x S&P is up 30%. Makes sense, right? The VIX, just one-time VIX, is up 50%. The 2x VIX is up 107% in 2 days. So when it works, it works. I call it the jackpot mode, and that's why people keep using them.
Suzanne, how do you feel about all of this as a personal finance reporter?
Well, my first thought is, does the world understand the term roll? We're throwing around roll, and I know that Bernard defined it really well in his recent piece. But is that a term that we think everyone is familiar with?
Let's break it down.
Yeah. So basically, what we're talking about here is the VIX is a projection about what the market thinks is going to happen in 1 month's time. So you're constantly pushing that out 1 month. And the way that these ETFs use futures is they're constantly, it's like a seesaw. And you start with one future on the expiry, and as you get nearer, you have to buy one and sell the other to keep that kind of seesaw balanced. And what's really ironic about these products in particular is that they're kind of doing this in kind of a funky, small futures market. And futures are not like ETFs. They're not based on like what the actual value of that thing is. It's purely based on the supply and demand from the market for that financial contract. So if you have a ton of money flowing into these products, that makes the cost of doing that stuff more expensive. Because the market's like, oh, people want to buy, people are scared like volatility is going to go up. So we're going to make it more expensive to sell them like that insurance. So the more demand there is for insurance, the more expensive that insurance gets. So these roll costs are getting worse and worse and worse the more money that goes into these particular products. Now, I don't think that happens as badly in other examples of these kind of ETFs. The other one was Bitcoin. Do you remember before you had like spot Bitcoin ETFs, you had futures ETFs that were based on the futures market. But again, they had very, very similar structural problems where you have the fees, but you also have these roll costs, and they're not really disclosed very well in the paperwork around the ETFs.
It's a big price for popularity.
But the term roll, I would just picture you're buying this future, which is due. Let's say, what month is it now? October. It's due in November. Now, as October ends and November comes, people don't want to take delivery, whether it's oil or VIX. Whatever it is, nobody wants, because they're just in it for the investment. They don't want to get delivered anything. So they sell the future right towards the end of the month and buy the next one. And sometimes they buy 2 months out. Well, the curve is always shaped where it's pricing a little more, because there's more chance of volatility as you go further out. So you pay up every time you go from near month to the next month. Unless there's a spike in vol, which then it goes in the opposite direction. And everybody, it's like when the guys are selling umbrellas outside of Penn Station when it's raining, all of a sudden everybody wants VIX. Then it's cheaper going out and you actually get paid to roll, but that's a very rare occasion. And the first thing is called a state of contango, and the second thing is called a state of backwardation. But I don't even want to introduce that because those are...
Please do not. I have written stories in my past life where I've had to try and explain contango and backwardation. And I would like you to know that on Wordle, the New York Times game, contango, when I tried to use it in the game, it was not accepted.
That's why they're all rated R instantly. Because I mean, who even knows what that means? It's backwardation sounds like what after you eat Taco Bell.
A contango is like it's a dance thing, but it's not
like
a real
dance.
It's a fake dance. It's a contango. It's not a real tango.
Oh, I love it.
So yeah, these are the terms that when you learn it, it makes total sense. But it takes a while. It'd be like sometimes when my auto mechanic explains stuff to me, I'm like, dude, fine, just spend the $800. This is what that sounds like to normal people.
I'm still trying to forget the Taco Bell reference.
I know.
So Suzanne, come into this as the personal finance brand.
Well, I'm a big believer in personal finance of keeping it simple. And so this kind of product, I'm sure makes sense for a lot of people, but I just sort of feel like be like the boring, sensible person, there are a lot of actions you can take on your portfolio before you need to get involved in something like this that is very expensive, really hard to understand, obviously appealing right now because people are leery of getting into equities, but they still, want to have some participation. And this the ability to sort of hedge your portfolio is a great way an advisor or broker or something can like hook you in to a product. But I just feel that there are a lot of basic things people can do, like boring old rebalancing, maybe dollar cost averaging out of like Mag 7 and adding a little international value to your portfolio, keeping a cash cushion so you don't have to sell into a downturn. I mean, I'm sure everyone's like falling asleep by now.
Eric, to Suzanne's point, we've been talking about maybe NC-17 stuff. What are some more PG options?
Most people would use treasury bonds or a little bit of cash. I think money market funds are great because they're just not going to move. But some people do want things that will go up when the stocks go down. And long-dated treasuries are usually pretty good. They went up 37% in 2008. But in 2022, they went down with stocks. So they're probably the best organic hedge that's like PG. Gold is interesting, but that's zero correlated. Sometimes gold will go up with stocks like it is now. That's the thing about gold. People are buying it as a way to maybe hedge stocks. and debasement as stocks keep going up. But if it's interesting that it's working as a high beta play right now because it's going up with stocks, but gold can sometimes go down with stocks. It's not totally reliable. It's more like a rebel. It just does whatever the hell it wants, which is kind of cool for a portfolio because you get diversified. And Bitcoin is probably in between stocks and gold. It's definitely more risky, but it's come down a little. Some days it'll go up when stocks are down. So I just think that's why people are out there examining all this stuff, because they do want to have diversification, which I do believe is the only free lunch. That said, I think where the chainsaws and the NC-17 stuff can come in handy is if you have a feeling that in the next week something real big is going to happen. Then you would just put a little bit of VIX in your portfolio, and you only need a little because it will go up like 5-8 times the market going down, and hedge everything. But you got to sell it after the time comes up, whether that thing happened or it didn't. My dad had this experience famously. He thought
did a whole episode about this.
He thought Hillary Clinton was going to win in 2016, and he thought the market was going to go tank. And he goes, "How can I play this? I'm sure of it." My dad's like a huge college football gambler. So I said, okay, well, look, if you believe this, it's going to put in TVIX. TVIX will pay off big if you're right. Trump won and the market went up, and he forgot to sell it. So all three things went wrong. And then he called me every like 6 months and said, what is this thing that like loses 50% every month? And I'm like, I told you to sell it. So if you're the kind of person who like
not a financial advisor,
doesn't pay attention to your portfolio, don't use any of those things. Just use the PG. But if you are a trader, their jackpot mode will go really far in hedging your portfolio. And that's why the pros do like to use it.
All right. So the thing that we haven't talked about yet, buffers. What's the state of play on buffers? What's their rating? What do inflows look like?
Yeah. So these would be PG, PG-13. We debate that on the team a lot, but let's just say they're PG-13 because they use derivatives and they're a little complicated. And you have to buy.
What do they do?
They basically use options to target an outcome. So like if you have to buy in on when the buffer comes out. So the ETF comes out October 1st, you buy it on October 1st, and it basically says something like this. If the market goes down 5%, that's on you. If it goes down further, the buffer will cover it. Other times it'll say, we'll take the first 5%, you eat everything after. And in order to arrange these downsides, you have to give up some upside. So the more downside protection you get, the more upside you give up. And a lot of older investors, that's why we call these boomer candy, they love this stuff because they're willing to give up some of that upside to sleep at night with the downside. These are popular because they guaranteed. As I just said, even Treasuries don't guarantee a hedge. These lock it in. The problem is they're pricey. A lot of them are not over 90 basis points. You don't get the dividend as part of the buffer. So you do give up some things, but I think peace of mind is something people are really willing to pay up for. And that's why they're a huge hit.
And I think they should be marketed as boomer candy because I think that's kind of brilliant.
It has stuck. I introduced this. I'd say one of every 10 phrases I try out actually works, and that was one of them. JP Morgan, I think, even made T-shirts with it for one conference. Yeah.
That's great.
And then Todd Sohn made me a boomer candy M&Ms where he brought a jar of M&Ms and he put like dividend income, premium income, buffer. And so he made literal boomer candy. It's a whole thing.
Yeah.
Yeah.
You had them on the show as
I know.
well.
We don't hang out as much as we used to. You would know, I used to write for her all the time, and you'd get a kick out of all this.
He wrote so many great ETF stories.
She was
for me.
the editor of the radio, How to Invest Based on Radiohead Lyrics.
Yes, that was awesome.
True. Bernard, are you seeing buffers show up in any of your data yet? Or is it more like the VIX is so different and odd that people are like, that's the thing that looks like real boomer candy? Or it's like boomer crack?
Because I know we talked a lot about like, can I just get really nerdy about options for a sec?
Do it.
What's fascinating about these buffers is they've started to kind of show up in the big options market. So you get a ton of like people who are trading options talking about the JP Morgan roll as this really exciting event because these things kind of target what's going to happen in the market in 3 months' time. And what ends up happening is the market kind of like looks at this as a bit of a target, kind of what's going to happen, and they kind of all the Wall Street banks and market makers are kind of positioning around these flows. The other thing is that there's kind of a sense of like these guys might be getting buffer ETF providers, because they've told the world when they're going to trade, there's a bit of an adverse selection issue, because if you've told everyone on this particular date we're going to do this massive multi-million dollar trade, I think it was like 20 million net premium for the last one they did, but it was hundreds of millions of dollars of options premiums in different directions, and this is like a huge thing for the rest of Wall Street. Unfortunately, JP Morgan's investment bank doesn't get to cash in on it because they don't trade themselves, right? But all the other banks, it's a massive deal, these buffers like rolling over and all that kind of stuff. Like it's hard to it is like a really kind of important thing for the rest of the market. So that popularity in the buffer ETF space is actually caused has a direct effect on Wall Street. Given its scale.
What are the buffer tickers that are the ones that people are most interacting with?
The biggest and first ever is BALT, BALT, 1.8 billion. It might not be the biggest, but it was the first. And you know what the ticker's for? Bond alternative, which is interesting because, as I said earlier, in 2022, stocks and bonds went down together, and this freaked the boomers out because they were told that bonds would cover the stocks, and they all went down, and it was like, whoa. So they crapped their pants, and that's when buffers got huge, because they come in, they say, your bond, as we say on the team, the bonds don't work. And so that's why these are mostly alternatives for bonds, although the bonds will, come back and say, well, since then they've gone up. The reason the bonds and the stocks are a weird thing now is because if the Fed's lowering rates, that tends to be good for both stocks and bonds, right? We all know this. So when they raise rates, it's bad for both stocks and bonds. And so that's why the Fed kind of like warped what would normally happen. Bonds, safe haven, stocks, risk. So the Fed and their influence on the market actually changed the dynamic. So buffer ETFs are pretty well timed. And the guy who invented them is a smart guy who created Power Shares, and he really helped put smart beta on the map, Bruce Bond. And it's interesting. And now all the issuers have them, including BlackRock and Fidelity and JP Morgan. So you have all these big issuers now riding the buffer train, and because the demand is there. And most of the money in America is held by the boomers. If you look at who owns the stock market, 70% of it is owned by people over the age of 65. And so servicing them with things to help them sleep at night is why we have this other theme about how ETFs are almost in the role of the pharmaceutical companies. This is a drug to help you cure your anxiety and sleep at night.
How expensive is this drug, and can I find a cheaper generic version of this drug?
There are a lot of competitors. So BlackRock came in with HEDJ, and it was about half the cost of First Trust and Innovator, which are the two big brands. And we looked, HEDJ did a good job. It launched right before a downturn, and it covered. It did not go down with the stock. So I think ultimately that guarantee that comes with the options activity is very powerful. I would just say this, though. I wouldn't drop everything and buy buffers. I would maybe, experiment with a little bit. I just really am a believer of a well-balanced portfolio. I think Buffett, Bogle, all the heavyweights would advise the same.
Which is 90% equity, 10% the Buffett model, right?
Well, the Buffett portfolio is 90% S&P 500 and 10% short-term treasuries, like a money market fund. That's what he is going to put his whole trust into when he passes away. And that's a pretty good portfolio, honestly. But that little bit of cash...
Is that a good portfolio for a 60-year-old?
Yeah,
that's the thing.
Might be losing some sleep over that
and,
one.
the boomers made so much money. That's why the crypto people are like... Whenever you bring up Buffett with crypto people, they're like, oh, try finding a Warren Buffett in Nigeria or Argentina. There are none. In other words... Buffett only exists because the U.S. stock market is so badass. He just happens to have been riding that whole 50-year bull market. There's a point there. But Buffett still is a smart guy, and I would just say that I would take heed to what he says for sure. But I don't know. I think a little gold, if you like it, is pretty good. Little treasuries. If you want to try a little buffer out, go ahead.
In gold, you can get a cheaper version of that too. You've got GLD, which all the traders use, right? But can't you get the gold, the mini, the GL?
Oh yeah, they got mini-me's all over the place in the gold area. GL, what the hell's the ticker?
GLDM.
GLDM is way cheaper. So shop around. GLD is probably the more expensive gold ETFs. But yeah, this idea of how to protect your portfolio is big. And that's why, as you said, the options market is very popular. It's not all people losing their mind. A lot of times you just buy a put option for a little while.
Yep.
And that's a sleep at night drug, if you will, as well.
Yep. Or you could sell calls as well. You could do call overrating, and there's a bunch of funds that do that. But basically, you can earn premium on your if you own a big stock, you can say, right, I'm prepared to I don't mind selling this if it goes up 20%. Like, I'm happy with that. And if it goes up 25%, you sell it, but you've earned a premium from that activity. And that's how a lot of these buffers and other ones there's a whole bunch of new ones.
Now you're getting into premium income, which is JEPI, which all it does is what he just said. It sells call options a little bit out of the money. So if the stock goes up, you get a little bit of it. But at some point, the call option gets hit in the money and people want to exercise it. At that point, you lose your upside. But the whole time, you're getting income from the option, from the premium, which gives you an income of 9-10%, depending on the index. That also is boomer candy. But the buffers are even more powerful because they lock it in. It's like locked in because of the options. The guarantee is what is so powerful. And guess who just launched buffers? ARK.
Oh, wow.
And yours truly influenced their name. Isabel called me, or it was Emily, I can't remember, and they said, what do you think of these? And I said, this is like Diet ARK. And so they called them Diet ARK.
Wow.
They just ran with it,
Nice.
Joel. How do you like that?
I mean, I knew you were an influencer, but I didn't know it was like that.
But the ARKs are a little different in that you get only 50% of the downside. But on the upside, you get like 50 to 80%. So they design them differently. Point being, if you're going to even play with buffer ETFs, I would almost consult an advisor or really make sure you read up on what exactly they're doing, and buy them on the day they come out. That way you get the whole thing. Because as time goes on, the numbers change on what's buffered because the market's moved.
Suzanne, closing thought?
I don't know. Eric's making me think I should go buy a buffer ETF, which is very sort of anti-me because I'm very much balanced.
I think he said consult a
portfolio.
financial advisor
Yes,
first.
yes,
So,
yes,
yeah.
yes, you did. I think, yeah.
And Bernard, anything else that we missed that from your corner of the options?
I just want to
perch?
bring up Jack Bogle because what I think is fun about the VIX ETF stuff is it's the most anti-Bogle thing I think you could possibly ever do.
This is
which is
Eric
trying
in a nutshell. It's
trying
like you
to
talk about Bogle and the other side.
This is the antithesis. This
Yeah.
is like it's the anti-Bogle.
He's rolling
is,
over in his grave.
Is just basically try and time the market. You are a genius and you can time the market. And if you buy one of these things, it doesn't matter that it's going to cost you loads of money because you are going to make loads more money because of your crystal ball that you're holding. And this is what good financial advice is. It's this idea that you are smarter than everyone else on Wall Street, and Wall Street doesn't have tons of PhDs and rocket scientists who built a system specifically to take your money. I remember I was chatting to a guy, a very large market maker in a senior role, and he said I was in an Uber going to the airport, and the driver was explaining, and I've had this conversation with Uber drivers as well. I'm trading these options, I'm doing so well, and this guy's job is to take that options flow and basically buys it from the retail brokers and trades it, and he's just like, yeah, this is a bad idea.
Well, I mean, to be also with Bogle, what he would probably say is don't buy anything. Just buy the S&P and use patience as your diversifier. And he even said you don't even need international. But that takes a lot of intestinal fortitude to survive what seems like a scary couple weeks or a year. But that's what Bogle would recommend. If you're younger, that's why I think low-cost index funds are a godsend, because a lot of people, they buy them and they know they got the best deal. And so they can survive the downturns easier going, yeah, what am I going to do? Try to trade around this. I'll just hold it. U.S. stocks usually go up. And that's why the flows are so sticky. So patience is also a hedge in a way, Joel.
Okay.
That's why
Yeah.
I said they've got to teach like meditation and Buddhism in the business schools or something, because just not trading. By the way, I pitched a show for Bloomberg TV called it was Seinfeld's a show about nothing. This is a show about doing nothing.
Okay.
It was going to have people come on and just talk about why they didn't trade that day, hobbies they got.
I love that.
Because that's
You're still waiting for a callback, aren't you?
yeah, no, it didn't. Way too boring.
I
Yeah.
like how we started with VIX and we ended up with patience. Like, we've gone every possible place. So, Bernard, Suzanne, thanks for joining us on Trillions.
Thank you for having us.
Thanks.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. I'm at Joel Weber Show. He's at Eric Balchunas. Trillions is produced by Magnus Henriksen. Sage Bauman is the head of Bloomberg Podcasts.